So we helped this family purchase their townhome in Centreville, Virginia back in March of 2024 using a conventional 30-year fixed mortgage at 6.625%. Here's the video we sent to them so they can learn more about refinancing and set the strike rate. When should they pull the trigger on the refinance? Check it
Hey there,
out.
it's Tim Kelly, and hope you are well. I just wanted to send you this video to walk you through the analysis I put together for you to help determine if now is the right time to pull the trigger on refinancing and or establishing a strike rate. So, little housekeeping before we kind of get into it. This video usually runs around 8 to 10 minutes long. If you stick with it in the end, I think you've got a lot of value out of it. Of course, you can reach out to me anytime you have any questions. But a quick tour on this analysis, think of it as a website that I created for you. Save it to your favorites. If you want me to tweak any of the numbers based off of your current balance being a little bit different than what I have in the analysis or adjusting the strike rates, which I'll go through here in a moment, just let me know. We have a total summary here in the top right corner. You can click on more info and it will show you a breakdown of the monthly payment. These are total housing payments, so it includes taxes, insurance, and mortgage insurance when you are looking at that housing payment. You can also click over on the closing costs and you'll see those broken down here. If you click fee detail at the bottom, it will show you the itemization of all of the fees. With a refinance, there are still closing costs, the cost for the transaction, the fees from the lenders, more title companies, transfer taxes, or recording taxes. And then there's establishing a new escrow account. So we're showing the estimate for the escrow account to be right around $3,000. So when you refinance, we're going to pay off your existing mortgage. Your mortgage has an escrow account that you've been contributing to every month when you make your mortgage payment. When the loan's paid off, that escrow account is closed. And then the servicer is going to mail you a check for whatever the balance is at the time that they receive the payoffs. So we're going to establish a new escrow account. So basically, the way that works is we are uh, just creating a wash. Basically, whatever you have in the escrow account and you'll be contributing to over the next month or two after you close on the mortgage, just depending on when you settle, it usually results in a wash. So when you're looking at the cost to refinance, I factored in all of the closing costs, prepaids, and escrows, and that $9,400 that you see across the board and all of these options, that includes everything. But the truth is, you can take out the escrows, and that'll show you the true cost of the refinance. So if I just use the option one now and just subtract the escrows, the cost is around $6,300. Okay, and that includes everything that you would pay when you refinance the mortgage. Now, how and why that's important? Well, that really kind of determines on when's the right time to pull the trigger. So if you're saving money, it doesn't cost you anything other than your time going through the loan process, getting the documentation in order, refinance. But there is generally always a cost. And in this analysis, I show that cost being brought to the closing table. However, unlike when you purchase the home, you own the equity now. So it's up to you to decide how you want to use your equity. So you can roll in all of the closing costs, prepaids, and escrows into your existing mortgage and increase it, but bring nothing to the closing table on the refinance. And so usually you can roll everything in. We have people who roll in the closing costs, but they bring the escrows or they bring everything to the table. What we can do is we can show you the different ways that you can pay the closing costs. We also can give a lender credit to cover some of the closing costs as well. So when the time comes to refinance, I think we can address that closing cost questions and different strategies at that time. Right now, the purpose of this video is to establish, is now the right time, or let's set a strike rate when it will be the right time. So I'm sure you've seen the news, interest rates, the Fed cut interest rates, but mortgage rates aren't tied to what the Fed does. So this is an article that came out 2 weeks ago. Basically, it's just, like many people, they saw what happened and what the Fed did, and they expect mortgage rates were going to improve as a result. But that just is not the case because the Fed does not control the mortgage rates. What they're doing is they're controlling the Fed's fund rate, which basically is kind of like monetary policy. Okay. So mortgage rates are set in the secondary market. Mortgages are bundled up and sold on Wall Street as mortgage-backed securities. They typically follow the 10-year treasury. So as the 10-year goes up, mortgage rates are going up. As it falls, mortgage rates are falling. So if you're ever looking for a key indicator to follow, the 10-year is great. Otherwise, there are some great websites and resources that monitor interest rates. And what we're doing for our clients is establishing the strike rate, establishing a system using our software that will monitor and price out your rate every day. And if we ever hit that strike rate, it will alert us, and we can jump on refinancing and taking advantage of the improvements. But as it says in this article, I think what's happening now with what the Fed is doing, they're dropping the interest rates to help stabilize the market, the jobs, and that helps stocks. But what that does is that kind of creates inflation, and it can create inflation, and inflation is the arch enemy of long-term rates like a 30-year fixed mortgage. And so as inflation goes up, or as the market perceives, we might see inflation stick around a little bit longer, get worse. You're going to see mortgage rates react negatively to that news. And during the press conference, the Fed was laying out what they are expecting to do, their forecast for future rate cuts, and the market perceived that as being a little bit inflationary. And as a result, mortgage rates have gotten worse since the press conference yesterday after the Fed meeting. So there's some great resources that forecast interest rates. I just think this is important to mention right now. This is the Mortgage Bankers Association forecast. It comes out once a month. We don't have September's yet, so it doesn't have the recent inflation data that we got this month. It doesn't have what the Fed did yesterday, but it's still important and something we can reference. And so this is set on the 20th. We'll get September's forecast in the next couple of days. But every month they publish what they think interest rates are going to do. And as you can see here, they did forecast last month that interest rates are going to fall as we approach the end of the year. And then in 2026, they're going to be averaging in the mid 6% range for the course of the entire year. And I think what was announced yesterday, if things play out like they were mentioned in the press conference, where the Fed is expected to do 2 more cuts this year, and then next year 1 cut. I think this could play out. The numbers might change a little bit, but we'll probably see maybe a little bit drop in interest rates over the short term. But then next year they could just kind of move sideways, which is important to mention what the strike rate does. The strike rate helps us take advantage of the opportunities, because rates will they'll hit new lows, but they don't last long. Just like stock prices, they change daily. And so you'll see interest rates drop. And as people lock in interest rates, investors will take their profits from the improvement, and you'll see rates start to rise again. Market's very fluid. There's also capacity issues where lenders run into problems trying to process all the refinances at one time, and they are worried about early payoffs for their existing pipeline, so they can kind of control and turn off the spigot, so to speak, to control the influx of applications coming in. So there's a lot of manipulation, a lot of things that can happen. And so what we want to do for our clients is help you get in position to take advantage of the opportunities as soon as it comes up, so we can establish a strike rate. Okay, so what we're doing here is comparing your current mortgage, which you have a payment right around $36.60 per month. Your interest rate is 6.625% when you purchase the home back in March of 2024. Today's interest rate isn't much better. It's 6.49%. So if you were to refinance today, you would save some money because it's a lower interest rate. You're also going back a year. Not that big of a deal, but that's part of the reason why your payment is improving, not just the interest rate, but you're restarting that 30-year clock in this analysis, and that saves you around $78 per month. But again, you've got to pay to do it, and you're spending around $6,000 to save $78 a month. That doesn't really make sense in my opinion. So I would not refinance now based on this current interest rate. And just keep in mind, this current interest rate factors in all of the adjustments based on your credit scores, your loan to value ratios. There's something called loan level pricing adjustments, which is not set by Atlantic Coast Mortgage or any bank or lender. It's set by the GSEs, Fannie Mae and Freddie Mac. Basically, the risk of you defaulting on the loan are analyzed, and they put together this grid, and all the different factors from credit scores to loan to value ratios, property types, the type of transaction, occupancy are all factored into the risk, and that risk is then passed on to the consumer in the price of the mortgage or discount points. So you'll see low interest rates advertised because banks and lenders are looking at the best case scenario, best credit score, lowest loan to value ratio, where there's not any adjustments. However, that's usually not the case. When you go to call in or see if you can get that rate, they say, okay, well, the rate in your scenario is a little bit different. You've got to pay points to get that rate, or we have to roll those points in and your interest rate is a little bit higher than what you see advertised.
So what do you think? At what rate would you pull the trigger on your refinance? And if you like this video, let me know. Give it a like. If you have questions, drop them in the comments. The purpose of this channel is to help you manage your mortgage and provide financing tips for your real estate goals. If you like what you see here, check out these other videos. The algorithm thinks you're going to like them, so check them out. And if you do, subscribe. The goal for 2026 is to get to 500 subscribers, and we would appreciate if you're one of them. Thanks so much.